R&D tax incentive is? If you don't, that's totally fine. Who knows what it is? I just want to see what the balance in the room is. So there's about 4 of us. What is it? In your own words. Came back from the tax office. Very good. ESIC. Who knows what ESIC is? ESIC. 2 people. Henry. Correct.
Something that you have to bring something truly novel and innovative, you can apply and get registered. And
why would you get registered as an ESIC? What's the benefit to who?
When you to
Yep, angel investors.
Yeah, they don't get.
Correct. Capital gains exemption for 10 years, and they get a 20% tax deduction that year. IBCC, that's a new one. Not surprised that no one knows about that. Innovation, business, CGT, carve out or concession, IBCC, because of what was announced in the federal budget. And I don't have a clicker. Okay, so we'll start with this. So true picture of Melanie Perkins before she did Canva. We were having a Japanese tea in San Francisco in July 2011. Canva was still 1 year away. She was doing Fusion Books. She was in San Francisco. I was in San Francisco for a tech conference, and she was looking for engineers. But in order to get engineers to do what became Canva, she needed money, and she didn't have any money. So she's looking for money in order to get engineers. Bit of a catch-22. Had neither. Came back empty-handed. Famously went back 9 months later, raised money, moved unfortunately to Sydney because no one here would back her, including me. But then again, she never asked. Oh. Because I'd sold my company here before. I probably would have invested if she'd asked. Anyway, so we all missed Canva, didn't we? So they went to Sydney, but stayed in Australia. And the reason she stayed in Australia was the R&D tax incentive. Huge advantage for investors and for the company. So I'll talk about that in a minute. I'll probably talk about that first. Am I going to talk about that first? Yes. So this is annoying without a clicker. I've got these lovely sides. I have to bend over. So I would say to Australian startups, ESIC continues, early stage innovation company. I'd think nearly all of you would qualify as an ESIC. If not, you will soon when you form a company. And that's a big advantage for your investors because they get a tax incentive when they invest in you. And not many people know about it. Angel investors who are active know about it. Angel investors who are active use it. I've used it on every angel investment I've done. It's actually been law for 10 years. Malcolm Turnbull brought it in. I talked to accountants. Do you know about it? They never heard of it. I talked to financial advisors. Do you know about it? They never heard about it. I talked to private wealth managers. Have you heard of ESIC? Never heard about it. Very annoying. Yes. I'll get it into more detail. But first year disclaimer, I am not an accountant. I'm not a financial advisor. Seek your own advice. Right? This is just Charlie Gunningham, regular person telling you his stories. Don't blame me if it all goes wrong. I'm just giving you information, right? But I have claimed ESIC and I have claimed R&D for 20 years, R&D. And I have claimed ESIC. And it's actually not as hard as it appears. You're all looking a little bit like rabbits in the headlights. Oh, it's tax. It's a bit complicated. Actually, it's much easier than it appears. Can be done, right? So, ESIC, correct, Henry. Early stage innovation company, right? You got a little handout. There's going to be some questions on there. You're going to answer the questions as you go, just to make sure you're on it. Also known as the Angel Investor Tax Break. This is the gig. This is the advantage. The angel investor, that's the person who invests in you if you're an ESIC, right, gets a 20% tax offset in the year they invest in you. So if they're investing in you today, in this year's tax year, that's 26-27, they can claim back 20% as a tax deduction of what they invested in you. So if they invested 10 grand in you, they get 22 grand off their tax bill. 2 grand wiped off their tax bill this year. But you have to wait till the end of the year to claim it, right? And even better, Because if you do invest in the next Canva, a 10-year capital gains exemption. That means if the company, so it's the second element to it. Oh, beautiful, thank you. The second element is if you do hit the next Canva and it becomes a $40 billion company like Canva and you get an exit within 10 years, tax-free. Amazing, tax-free. What an amazing, that's actually a bigger advantage than the 20% tax deduction. But the immediate advantage is in the year you invest, 20% off your investment. Now, if you're a sophisticated investor, and I won't go through what that is, but you can Google it. If you're a sophisticated investor, the maximum benefit you can derive is $1 million in any 1 year, right? If you are a regular mom and pop investor like me, not a sophisticated investor, the maximum you can get is 50 grand, right? You have to be a passive investor. That means you're not running the company, you're not director of the company, you're not an employee in the company, you're an investor. You're passive. You have to own less than 30%. If you're more than 30%, you can't get the ESIC. So, you know, you own 1 or 2% or 5%, you put a bit of money in, you put in 10 grand, you put in 20 grand, right? And if you hold it for a year, you got to hold your shares for a year and sell within 10. If you hold for a year, you're passive, you own less than 30%, you're not running the company, you're a silent investor, basically. And they must be for new shares, not con notes or safe notes. So safe note, simple agreement for future equity, is a convertible note. It'll convert to shares immediately. Sorry, not later, right? According to the terms of the safe note. Safe notes don't count, con notes don't count. It's got to be fresh equity. Clear? So those are the rules. Sounds a bit complicated. Actually, it's really easy. Going to work? Yes, I like it when things work. How do you qualify? ATO has a really good website. You can Google ESIC, ATO, or early stage innovation company, and you'll go to this website, and it shows you how to qualify as an early stage innovation company. It shows you all the tests. There's 2 tests, basically, a principles test and a 100-point test. Couple of other things. You have to be unlisted. You can't be listed on the stock market. You can't be a public company. You've got to be a private company. Sole trader, sorry, Henry, doesn't count. You've got to be a company. You've got to have revenue of less than $200,000 in your last year. In your previous year, your revenue's got to be under 200,000 and your cost less than $1 million. So we're talking early stage innovation company. And you've got to be doing innovation. You've got to be less than 3 years old. There's 2 tests, 100 points test or a principles test. I won't go into the details. They're all on the ATO website. Yes, you can self-diagnose. You don't need an expensive accountant. Yes, accountants will charge you a lot of money to qualify you as an ESIC, but they will go over the top and they will charge you money. In my humble opinion, you don't need it. I've never needed it when I've claimed ESIC. I've written a half a page as the investor explaining why it's an ESIC, done. And I've got my money back off my tax. Not that difficult, right? I'm amazed how many startups don't know about it either. If you're an investor, if you're seeking angel funding, most of your busy angel investors like a Rob Nathan, etc., who's invested in over 30 companies himself personally, or a Wilson Casado from Varsagio, who's done 70 investments himself, or Tracy Clark, amazing, she's done 30 or 40 herself. They know ESIC. Perth Angels, they'll all know ESIC. They claim it, they use it. Been around for 10 years, hasn't been touched by the recent federal government, still exists. So, worked example. Investor lodges their tax returns, including any ESIC from the previous year. For example, the investor has invested $10,000 for new shares in XYZ startup, explains why and how it is defined as an ESIC, lodges this as half a page with their tax returns. The investor then gets $2,000 deducted, that's 20% of the 10 grand, deducted from their tax, owed to the ATO. So if they owed money to the ATO, 2 grand takes off it. Or if they get money back from the ATO, 2 grand is added to it. Oh, how good's that? But later, one little thing, you can't claim a tax write-off if that startup goes to zero because you've already got your ESIC. You can't, so, you know, some people invest in companies and they know they have a portfolio and they're going to write off the ones that lose to try and minimize the tax they pay on the one that wins. If you've claimed ESIC, you can't also write it off as a zero I've lost all my money on this. You've already got your ESIC gain. So some people who are very sophisticated and do a lot of investments don't use ESIC because they want to use the losses as a tax write-off. Okay, so you can't do both. Do you qualify as an ESIC? Take 2 minutes to determine whether you do or not. I've taken you through. I've taken you through the qualification. You've got 2 minutes. You qualify as an ESIC? No, you don't, because you're a sole trader. Michael, do you qualify as an ESIC?
Yeah.
Because? Less than 1 million costs and less than 200,000 revenue. And so you'd go have a look at the 100 points test, because some tests, like if you do an accelerator program like this one, that would give you points, right? Gives you 50 points of the 100, something like that. So you're already halfway there to proving that you're an ESIC. So there's a 100 points test, and there's also like a principles test. If you hit these principles, you're an ESIC. Okay? You guys an ESIC? Architect IQ? Smile, not yet, because haven't formed a company. You're a sole trader, haven't formed a company. Haven't formed a company. Haven't formed a company. Sole trader, okay. But the point is, you understand how to become one if and when you're a private company, yes? And if you're looking for angel funding, it's not a bad little advantage. Any questions about ESIC?
An ESIC company.
Yeah, if you try and use an accountant, so don't do it. They will make it really complicated. They will charge you money because it was new. Some people did this. You don't need to. I've claimed it.
As an investor.
Yes.
So
you don't have to claim it, get the tax benefit. The investor does. You've got nothing to do except be an ESIC. They have to prove, the onus is on them to prove on the day that they invest that it was an ESIC. By the way, the next day you can list on the stock market. It's the day you invest. 100 points or the principles test. Yeah. Means that you are not you're a passive investor. You're not actually running the company. You're not a director. You're at arm's length. You just put money in and go, good luck. Can do, but that shouldn't get in the way of ESIC. Right, R&D tax incentive. Another, this time, a 4-letter acronym to amaze your friends at parties. Oh, about ESIC. Can't do both. You can't claim the tax loss if it goes down the toilet if you've already claimed ESIC. That's double dipping. You can only do one or the other. Some companies, for the passive investor. You as a founder can. That's nothing to do with it because you haven't claimed ESIC yourself as a founder. You're not a passive investor. You're active. You're working on the company. You cannot claim ESIC, right? You can, if it goes down the toilet, you can write your shares off as a loss against any profits you make. I'm sure that's not what you're planning to do. All right, so amaze your friends at parties with ESIC, especially startup parties. Ooh, ESIC, what's that? And RDTI, Research Development Tax Incentive, otherwise known as, well, we'll get to that. It's one of the largest sources of government support for business R&D in Australia. 13,000 Australian businesses claim this every year, half as small with less than 10 million revenue. It churns out 6.2 billion Australian dollars to those 13,000 companies in R&D tax rebates. Wow. Imagine getting a check back as a company, not an investor, this is you as a company, from the ATO. How good is that? ATO giving you money back? This is unheard of. Well, it's what they do. It's one of the biggest, it's bigger than venture capital. The total venture capital market in Australia is about 5.5 billion. So it's even bigger than that. It's bigger than the whole entire venture capital industry in Australia. And it's coming back from the Australian government. No wonder it kept Canva in Australia, right? So, stop working. Oh, no, it's a bit slow. Did I go on too far? No, I didn't. Okay. So turn eligible R&D spend into cash. Now, the thing here is, a bit like ESIC, you have to spend it first and claim it back, right? So it's not like a grant where you get money up front. It's not like someone investing in your company, you get money up front. You have to spend the money first on eligible R&D. What's eligible R&D? Again, you can go and Google it. There's ATO, tells you exactly how to do it. You spend the money first on eligible R&D. It's got to be spent in Australia, but things like developing a new product is eligible R&D. Buying a machine is eligible R&D. Doing tests in a clinical lab is eligible R&D. So all that spending that you're going to do anyway, right? You could get 43.5% of that back from the government as a check at the end of the year. Pretty good. Otherwise known as the R&D tax rebate or the R&D refundable tax offset. You've got to have a turnover of less than 20 million. And your offset rate is your corporate tax rate plus 18.5%. Now, most of you you're not making profits yet, but should you be operating and making profits, your base startup tax rate is 25%. So 25% plus 18.5% is 43.5%. So that's why I said you get 43.5% of it back. The minimum spend is 20 grand. So if you're only doing a grand's worth of R&D in a year, sorry, it's not good enough. The minimum is you've got to be spending 20 grand, and that actually is going to go up to 50 grand from 2028, which is a bit vicious. So that's going to cut a lot of startups out that aren't spending that much. But I suppose it's becoming so fiddly and the administrative burden for the ATO, they've decided to go down that road. Yeah.
Is that just off one project, or it can
No?
be like a summary of projects, whatever you spend for R&D during the year?
Good question. So you've got to set up a hypothesis, and it could be a series of projects where the outcome is unknown. So it's got to be almost like a science experiment. This is not stuff for known technology. So if you're just putting up a bog standard website, that's not eligible. It's got to be something a little bit more innovative, and you're doing something new and novel. And again, that's defined by the ATO, but definitions are there. Sorry? It's R&D, research and development. Sorry?
What about projects, say, like building and manufacturing or something? That wouldn't be.
Building and manufacturing doesn't sound innovative or novel.
It could be if we're using advanced methods.
I don't know, and I'm not an accountant. You'd have to look at all the ins and outs.
There are tax rebates for companies over 20 million in turnover?
Don't know. Don't know. Good question. Don't know. Way back when they started. When they didn't have 20 million revenue. Way back. They're not getting them now. No. Nothing offshore. It's got to be spent in Australia. Cannot be offshore spending. Money spent in Australia. How to claim. Must be already spending in Australia. You've got to have a hypothesis that you set up at the beginning of the year. It's got to be some sort of experiment with an unknown outcome. And then you've got to evaluate that outcome and have a conclusion, right? It sounds harder than it. That's not hard. You can do that, right? You've got to keep your R&D spending records as you go through the year. Have a little spreadsheet or a database or something where you're just having a little diary of your R&D spending. Spend it on this, spend it on that, blah, 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 blah. So remember, you've got to spend it first and claim it at the end of the year. And you lodge your R&D claim with your tax returns for your company at the same time. I'm not talking about your personal tax returns. I'm talking about your company tax returns for those of you who've got companies that are trading. You lodge with Lodge Industry, and that'll give you an R&D registration number. You need that R&D registration number. That's a new thing. I didn't have that when I was doing R&D claims. You calculate your eligible expenses. You file your tax return with your R&D schedule as part of it. And then you wait. Normally not too bad. It can be as quick as 2 or 3 weeks, but can be 6 weeks, and you get money back from the government. Boom. Dylan. You're just standing there looking cool. Excellent. You know what? And companies, because this is now assured, this is not a grant, right? If you follow the rules, you get this. There are now companies that will lend you money against your future R&D claim. You won't get 100% of it because that's how they make their money. But you can make your money on it during the year. That'll fund you during the year as you're doing your R&D. So if you successfully have claimed R&D in the past and you're now in year 2 and you successfully claimed it and you're pretty much carrying on and maybe a bigger number, there are companies like Radium Capital, it's one of the biggest. They will actually lend you money now, cash into your business, and then when the R&D claim comes, you pay them back and then they take their cut. So that's one way of funding your company. Not waiting to the end, you can actually borrow against it. I've had startups that have done that. Some people like that, some people don't. Depends on your ability to get cash elsewhere, I suppose. So you can actually borrow against it. Interesting. Here's an example. XYZ startup spends $150,000 in a financial year on eligible R&D. They're loss-making. Their revenue is 250, their costs are 300. So they're making a loss of 50 grand. So they're loss-making. Effectively, what they're doing is they're converting their losses into cash from the ATO. The calculation is that they will get 43.5% of that. That's $65,250. That's 43.5% of 150. They will get $65,250 cash back from the ATO. They were making losses of 50 grand. They've now converted that into a $15,250 cash positive year. Pretty good. And you know the other thing? That money they get back is tax-free. That won't be taxed. How cool is that? That comes in as income, but it's not taxable. So how good is that? This came in, actually they've been doing R&D tax rebates since the 1980s, but it was early 2000s, I was running my startup. And I heard about John Howard, the then Prime Minister, jumped up and down about this R&D tax rebate. In this way became very interesting for startups to try and encourage innovation in Australia. I spoke to my accountant and they said, oh, no, you're not eligible. I went, okay. And then I spoke to another accountant and they went, oh, no, you're not eligible. And then this is how Perth works. I was at an EY networking event and the guy I did my MBA with, who was a tax accountant at EY, said to me, are you claiming the R&D tax rebate? I said, no, I've been told I'm not eligible. He said, you're definitely eligible. And did you claim it last year? I said, no. I said, right, let's have a meeting. I reckon I can get it you for this year and I can get it for last year because last year it came in and you didn't claim it. And because people didn't know it was existing, you can claim last year's and this year's at the same time. I went, no way. I said, yep. We got a check back. And I remember because it was on Melbourne Cup Day. It was really quiet. We got $110,000 check back from the ATO. And Nick and I went down to Broadway, Westpac, and there was no one around because it was Melbourne Cup Day. And we put it in the bank and we were like pinching ourselves. We just got $110,000 back. That was like the world back in 2003, 2004. Would I do that? Warren, the idea. Dylan. They didn't know it. They didn't understand it. Like, as I said, most accountants and most financial planners do not know about ESIC. It had just come in. They didn't believe I was eligible. It was new. Most accountants now can do it for you. This is quite complicated. So you've got things to do, like keep a register of your spend. You need to work with an accountant to do the R&D tax schedule. Most accountants can do it. Just an additional thing to do as part of your tax return, right? There are also people that set themselves up as R&D tax specialists. One is called Evolve 3, which is Steve Carroll, who does the innovation calendar. He's an expert on this. He used to work at RSM. There's people you can go to. Just a quick thing. I don't want to confuse you too much, but you can't do double dipping. So you can't win a grant for the same R&D activity that you've won an R&D tax rebate on. Now be careful on this because remember, let's say you do some amazing R&D right now and you wait till the end of this year, which you should do, to do your tax claim. You can't get a grant this year for the same activity. That's double dipping. You can't be paid twice by the government for the same activity. You've got to ring fence the R&D activity that you're claiming for R&D tax away from anything else. So be careful. You can't win a grant. Aha. Your space one. Yeah. Aha. Ouch. Yes. And this is a bit, I was loath to even put this in, but this is just for those of you who love accounting technicalities. Remember I said it was tax-free, the 62,250 or whatever it was? You've then got to, for those wages that you've claimed, you've got to ring fence them as well. You can't be claiming them as wage expenses in the following year to try and reduce your tax bill. You've already been paid for those wages, 43.5%. You can't then go and take them off as expenses. It's a bit complicated. Your accountant can deal with it. Just be aware. No double dipping. Okay? Don't ask me a question about that. Good, because I don't want to explain that again. Yeah? No. No, I was allowed to do it for 2 years because it had just come in the year before and I'd missed the year before. I don't think you can do 2 years in once if you get going. Worth asking the question though. So do you qualify for R&D tax incentive? Will you qualify this year? This year? Will you spend 20 grand this year on R&D? Will you have a private limited company? Will you do a tax return? Will you spend 20 grand on eligible R&D in Australia this year? This year, 26, 27? 26, 27. We're in July. Oh, we're in July, August, end of July. We're beginning of the 26, 27 year. Or another question, did you qualify last year? Did you spend 20 grand last year? Probably not, most of you. There's no points test here. It's just, have you spent 20 grand on eligible R&D spending in Australia? Is this something who thinks they might be spending it this year, coming up? No? 20 grand? Warren might be. Henry might be. Okay. No one else? You won't be? You won't be spending 20 grand on R&D this year? Yay! I mean, I'm surprised. No? Ocean Planet, building it, R&D, researching. Researching is included. Research and development. It's not just development. Research and development. Okay. Quickly, because I've just run out of time, quickly on the IBCC. This is coming in next year from July. So it probably wouldn't have been above your attention. In the federal government budget in May this year, they announced the abolition of a 50% capital gains tax discount. Now, the 50% capital gains tax discount came in with John Howard in 1999, and everyone sort of just got used to it. You get 50% off your capital gains tax if you buy an asset. But this has been one of the reasons we've had this massive run-up in properties, and no one can afford properties anymore because investors are getting a 50% capital gains tax discount. So Jim Chalmers decided to remove it from 2027, trying to calm down the property market and make it more affordable. He called it intergenerational fairness. The trouble was he hadn't realized this also affects startup investing and innovation company investing. And he was basically going to destroy in one stroke the startup industry. Who would want to invest if you're not getting the 50% capital gains exemption? Startup investing is not like property, where you've got a guaranteed income coming in from rental returns. And then the property market keeps going up and you just cash in. It's pretty much a money-making thing. Startups are not like that. Most of them are not going to work, right? Which is why we need ESIC and R&D tax to try and encourage them. So he pretty much single-handedly would have destroyed the sector. So what they've now introduced very hurriedly, a few weeks after that, was the IBCC. Another four-letter acronym to amaze your friends at parties with. They've carved out what they call innovative businesses. This is the Innovative Business CGT concession, right? Now, ESIC is untouched. So most of you, this is irrelevant, but it could become relevant to you in the future because you'll use ESIC, won't you, if you have angel funding. And that gives a 10-year capital gains exemption. And you're exempt. That has not been changed. So you can still use ESIC. But if your income's less than 50 million and your capital gains is less than 10 million, you can use the IBCC carve-out from 2027. Now that's probably going to be most of you. I'm sure Chloe would love it if one of you gets income more than 50 million and your capital gains is more than 10 million. I'm sure it'd be great, wouldn't it? But if you do, you're going to get slugged by the CGT. You will lose your 50% discount. If you're an overseas investor, you're going to get slugged anyway. If you're a listed company, you get slugged anyway. Yeah, you're going to get slugged anyway. There is no carve out for overseas investors. So if you want an overseas venture capital firm or you list on the stock market, you're going to be hit by the CGT. You're not going to get the discount. You're only going to get the discount if your income's less than 50 million, if your capital gains is less than 10 million, and you're an innovative business in Australia. Yeah. The point of this is ESIC is only for companies where your revenue in the previous year was less than 200,000 and your income, your costs are less than $1 million. As soon as you go over that, you can't get ESIC.
Yeah.
So, and I'm sure you have the idea and the dream, Henry, to have revenue of more than 200,000, don't you?
Yeah.
I mean, one of your bloody batteries is going to cost $500,000 as it is, right?
Yeah.
So you're going to be way over ESIC. You're going to be in this territory. So IBCC is going to be relevant to you.
Yeah.
It may not be relevant to everyone else yet, but if you have an aspiration to do a unicorn, and Chloe wants you all to be unicorns, right? You're going to get hit with this. This is bad news for unicorn building. This is bad news because the most successful tech companies in Australia are going to be hit by that. So they might go and set up in Delaware, the US, or they might go and set up in Singapore. We might see an exit. We'll see. Correct. You don't get a carve out for foreign investors. So foreign investors are going to get hit from July 2027 with the extra 50% capital gains exemption. I'm afraid. Yes. This guy is looking pretty happy, but not very happy. There's a little bit of a carve out, but not very much. Right? Bless your cotton socks. All that said, I'm not an accountant. Get your own professional advice. But I have claimed R&D tax many times. I claimed it all the way through my Aussie home journey. Obviously, when I went to REWA, they were not-for-profit, peak company, no. But when I went to Business News, I was amazed they weren't claiming it. We started claiming it, and we got $135,000 back the first year, and we got more and more at each, because they were doing a lot of R&D and new stuff that was quite innovative. And I've used ESIC on my last few angel investments as well. So it's not as hard as it appears. Hopefully, that's given you an overview of it. Any questions? Because that's the end. Yes.
One more just tagging along to the IBCC. So the headquarter, I presume, has to be in Australia.
Mm-hmm.
So the headquarter is somewhere else, but you have, I guess, major operations in Australia.
Yeah, that's a tax question. International tax, I don't understand. But that's the question for your international tax person. Was that helpful? Tell you more about ESIC? R&D tax incentive, and the new one, IBCC. Basic rule is just go create a great company, make lots of money, solve lots of problems for people. Tax will take care of itself. Pay tax. If you're successful, you pay a bit more tax. It's okay. It makes the country great.
You pay someone to not make you pay tax.
It's so complicated. You're probably right. No more questions? Daniel's already leaving. Okay. Good luck in your class, Daniel.
Thank you. So the government, the incoming new budget basically removed the 50% CDT.
Correct. From next year, 1st of July 2027.
So this